Welcome back. It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Barry Schwartz. He, of course, is with Baskin Wealth Management to, Barry, challenge some conventional wisdom, because there are a lot of investors and a lot of professional investors as well who really believe in the wisdom of buying and holding dividend-paying stocks for a long period of time. They like the compounded growth that you get in that flow of dividends. Yeah. You challenge that wisdom.
Well, what's going on, Paul, is what I call nightmare on Yield Street at the moment, because the companies that you bought that were paying dividends of 5% are now, you wake up and they're paying dividends of 8%. And it's not like the companies have changed very much, but the prices have dropped dramatically. Paul, you and I are old enough. We're not old guys, but we remember these income trusts. Right. We remember the 2000 era. The dividend-paying stocks and income stocks at that time paid 8 to 10%. I remember when I started in the business, REITs were paying 10% yield. And in the 2000s, interest rates were very similar to what they are today. So you shouldn't be surprised that some of these dividend payers have fallen in price because interest rates have gone up.
Right.
So interest rates affect dividend payers in so many different ways. Right. First of all, you have to be compensated. Why buy a dividend payer when I can get 5 or 6% on a GIC? Mm-hmm. Second of all, it impacts their earnings. Higher interest, a lot of them are levered. They've taken on a lot of debt. Higher debt costs mean to service mean less maybe to earnings and dividends. And finally, a lot of these companies base their growth on big capital expenditure projects. When you run the numbers, simple math, it doesn't make as much sense to go out and fund these projects when you have to borrow at 7 or 8%. So all of these reasons impact the dividend payers. Plus, they're slow-growing businesses. That said, some of them have fallen to pretty attractive levels. But what I tell clients is, let's not be married to any one factor, dividends, growth. Let's have a diversified portfolio. We don't need to only own banks, utilities, pipelines, and REITs. And I don't care if you're a retiree or you think you need low risk. This is not investing. Investing is owning companies, and different companies that will protect you in all different types of environments. We've been blessed, Paul, for the last 30 years because interest rates have gone down, right, or 20 years. And that's made those dividend payers all that much more attractive. If we go back to a world where interest rates are 5, 6%, bonds are 6, 7%, you're not going to get a lot of growth from these dividend-paying stocks. Mm-hmm. Maybe you get the dividend. Maybe that's all you need. But I would recommend start adding some more growthy names to your portfolio. As always, nothing has changed.
Okay, and you've got some that you like. You have, for a long time, have been a big fan of and an owner of Constellation Software.
Absolutely. So what I want our clients to own is the best companies wherever we can find them, or have business models where the management is so good at reinvesting the cash flows. So the conventional wisdom, Paul, is a company has earnings and it pays out a dividend, and that's great. That's not how you get growth. You take the earnings, the cash flow, and you invest it to grow the business, and that's where the big money is made. And that's why Constellation Software has been the best performing stock on the TSX for a very long period of time, because it doesn't pay you a dividend, it reinvests the cash flows to grow its business. And it's still early innings for this type of business, because there's so many acquisitions for them to make worldwide.
TFI International is the trucking company. It's also one you like from this point of view.
Same thing. This company is an acquirer of businesses that may not be in the best shape, or buying businesses where others have to divest them, building out its empire in Canada and North America in the trucking and logistics business. This is not a sexy, exciting business, but the returns have been totally amazing. And Alain Bedard and his team have been able to grow the business by acquiring, integrating, cutting costs. And trucking is still a huge, huge business in the U.S., and just in time, because it looks like the freight recession in the U.S. is over.
And it does pay a dividend, but it's a small one, 35 cents a share, and that's only a 1% dividend yield. So it's not a dividend story.
They grow their earnings and they pay out dividends, and the dividends kind of grow with earnings. But they're not trying to attract investors with a high dividend. The management wants to make money for itself and for you, and to do that, it needs to grow the stock price.
Alimentation Couche-Tard, the convenience store king, has been a big grower of its business over the past past couple of decades.
Same exact strategy. You just look at Constellation, look at TFI, you look at First Service, you look at Couche-Tard. These are companies that know how to acquire businesses, integrate them, cut costs, and it's a simple strategy. You use use that cash flow to reinvest. It compounds like nobody's business. I mean, this Couche-Tard has also been one of the most incredible success stories in Canada, but it grows its dividend, Paul. So if you bought this 10 years ago, your yield on cost is pretty good, right? So I'd rather have the dividend growing, the earnings growing, instead of a stagnant business, in a mature industry.
Dividend yield here, only 80 basis points, less than 1%. What about the fact that Canadian dividend income gets treated favorably when you file your taxes?
Listen, I'm not going to invest based on taxes. That's like picking up nickels in front of a steamroller. I want to invest based on the best growth wherever I can find it and not overpaying for it. Paul, if a business is only going to grow 1 or 2% a year, that's the best return you're going to get from it. Some of the dividends may be there, but keep in mind, those balance sheets are levered. I'm not going to mention names, but a lot of these companies have debt levels that are very, very high, and one mistake away from cutting the dividends, especially now where interest rates are today. So the management of those companies has to pray that interest rates come down.